Reggie in Jonesboro. Reggie writes, I'm getting closer to retirement, 61, he says, and even though I've got a good amount saved, I'm worried about rising healthcare costs. What should I plan for? Man, that's a great question from Reggie. Great time to be thinking about it. He's a little bit short of Medicare age. Obviously, Medicare is the first thing you think about, John, when you think about retirees' health care. And it is a great program that covers a lot, but there are costs to think about with it.
Yeah, and so let's talk about short-term and long-term problems here. The short-term problem is you've got some short-term issues that you've got to deal with. As Scott alluded to, you've got Medicare Part B premiums. Medicare Part A is free. Everybody gets that at 65. You don't have to pay for it out of pocket. It's something the government provides to you through the tax dollars that they collect. Medicare Part B premiums could be tolerable or they could be very expensive. It all depends on IRMA. Now, I had an Aunt Irma, and she's long gone and passed away, but this isn't the IRMA that we're talking about. This is the IRMAA. It is the government's word for basically means testing the cost of Medicare Part B. If you make a lot of money, then they're going to charge you the IRMA tax on top of the standard Medicare benefit. The standard Medicare benefit is about $183 a month, but IRMA, Scott, can go up to $428 per month per person, depending on your income.
Yeah, so how much you're taking out in retirement, which would go back to those IRAs, right? If you're taking huge IRA distributions, if you've got a big pension, your Social Security, all of that piles in there to the income that you're paying taxes on. And if you're having a very robust retirement, that's something to consider, is that your Medicare Part B premium could be very expensive, up to $428 per person.
Yeah, and I misspoke. The base premium on Medicare right now is about $165 a month, but it could be as much as $428 depending on your income. Now, so you got that. You also have a Medicare supplement policy that you will likely need unless you have some tail coverage off of the employer plan that you have. Some companies allow for them to continue to carry retiree benefits for health care. And if that's the case, then that actually will be the supplement to Medicare. But most likely you will need some type of Medicare supplement coverage that would be provided by an insurance company. Some people opt for Medicare Advantage because they think that it's a cheaper issue. We can demonstrate very clearly to you that Medicare Advantage is not always the best choice for most people. So you've got deductibles and co-insurance that you've got to deal with. All of that's in the short term. Scott, I think the bigger problem, and the one that Reggie may be asking more about, is the long-term problem. And in 2022, if you take an average 65-year-old couple, Fidelity did a study, and they found out that the average 65-year-old couple will spend about $315,000 a year on health care. And $315,000 in their lifetime on healthcare, not a year, but on their lifetime on healthcare. Most of that cost is largely sort of end of life type expenses and things of that nature. But a big part of that is long-term care expenses. When you think about nursing home care, home health care, hospice care, all of those kind of lump into the long-term care category, Scott, that can devastate someone's retirement portfolio.
Yeah, and that is something, Reggie, if you're 61, you need to be addressing right now. With a retirement income plan, you can determine where you fall in one of three silos, right? And most people who have assets, when he says he's got a good amount saved, this would certainly be Reggie. Most people who have assets would not be one of those three, because Medicaid is the option for people with no assets or very, very little assets. The other two options become, are you going to be able to self-insure in the event of a long-term care need, or are you going to need to leverage an insurance company and get a long-term care insurance policy? This is something we talk about with all of our clients who are about to retire, and really it needs to be addressed between 55 and 60, but Reggie can certainly do it at 61. If you have overfunded retirement, as we would say, based on the income needs you have and the assets that you have, then there is a possibility to self-insure. You can put aside a silo of money that is designated for and invested for the event of a long-term care need. But if you can't, you have to look at are you going to be eligible? Do you qualify for a long-term care insurance policy? Let's spend just a couple of minutes on talk about that, because people hear about that. I know they're interested in it. They don't really like to get serious about it because it's something that is not the good news of retirement. It's the bad news of retirement, but it's the reality. Statistics tell us that 70% of Americans are going to need some sort of long-term care. So what do you do? Well, if as far as the insurance options that are out there now, the traditional long-term care policy, which most people are familiar with, is a use it or lose it proposition. In other words, you're going to pay premiums for a policy that will pay for you if you need long-term care. What if you don't? What if you're in that 30% that don't wind up needing it? If you pass away suddenly from a heart attack, you've used all of your money for those premiums and you never got any benefit from them. And oh, by the way, that premium is likely to go up over time. Whatever it starts at is not likely to be what it's going to be when you actually need care. So can you afford the increases in that insurance policy about the time you need them? Sometimes it's people step off of that care, off of that policy, and walk away from it because they can no longer afford it. Those are the downsides of a traditional policy. The other side of that is a hybrid policy, and these are relatively new in the industry. It's a life insurance policy, but it has a long-term care rider on it. So let's explain what that is. Basically, the way we describe it to people, John, is that you're buying a pool of money.
Right.
Someone is going to get paid. So if you do not need that care, you're part of the 30% that doesn't, then you're going to be able to pass that pool of money on to your heir as a death benefit. But if you need it for care, you'll be able to drain it until it's done. There is an end to it. It's not unlimited in that case, but you'll be able to pull off of it. And as you're fond of saying, John, it's not really long-term care insurance, or nursing home insurance. It's stay out of the nursing home insurance.
Yeah, you've got lots of options with that money. It's actually at your discretion how you spend that money. You don't have to have a licensed provider or anything of that nature. It clearly could be paid to a caregiver that's in your family or what have you, or you could modify your house to accommodate for a disability. There's all kinds of things that you can do with the hybrid life long-term care policy, as opposed to the type of policy that Scott was previously talking about, which we generally call traditional long-term care insurance. So some options there, or you could look at self-insuring, but you have to understand how that might impact other people that, as our previous caller asked about, other people that might be depending upon that nest egg of money that you could use for their retirement income if it were not for that long-term care need.
And one other thing to think about for Reggie and anyone else listening, getting close to retirement, worried about healthcare costs, and you heard that number, average 65-year-old couple will spend $315,000 over their lifetime on healthcare costs. Not all of that is long-term care. So there's going to be a lot of out-of-pocket expenses. So you need to have assets saved so that you can pay for those. But you can also, if you have a health savings account option, I would get after that for sure.
Health savings accounts are great because you can put money in pre-tax and then use that for unreimbursed medical expenses. Clearly something that Reggie ought to look into as well. And Reggie, by the way, we have an insurance expert on our team here at Gen Wealth, and we can help you with that if you simply reach out to us at our phone number, 866-653-PLAN. That's 866-653-7526.
And one final note, too, if there is we started with Medicare. We started with 65, but Reggie is 61. If Reggie wants to retire before 65, then he's going to have to find some health care coverage, some health insurance prior to Medicare age. So if you're retiring before age 65, know that Tony can help in that regard too. He can go out into the marketplace and find a policy. And really, here's one of the things I think people don't realize. If you're in good health and willing to be underwritten for that policy, it's really not as expensive as you might think.
Yeah, and depending on your income, there are some income benefits that they give you to offset some of the actual cost of care. So it could be a very viable option for folks that are, let's say, middle income folks that are trying to get to retirement and they would retire but for the need for health care coverage. It's something that we can explore for you, help you to understand what that looks like, and make an informed decision. I think, Scott, really and truly, on all of this stuff, it's really all about making an informed decision about everything that you're doing, looking at all sides of this. And oftentimes you don't have time to think about that. It's a burden to do all the research and everything. And it's what we do every day. And so what we've done here at Gen Wealth is to assemble a team of experts in different areas of finance that we can pull together to solve whatever problems that you have coming to us with, and try to deal with those in a very effective way and give you options. Life is all about having options. When you have options, you feel like you have freedom. And when you are able to choose your course through a well-researched situation where you go, okay, I've got option A, option B, or option C. I choose to do this. Then you have made an informed decision instead of some knee-jerk reaction or hearing something on social media that you think, oh, that sounds good, I'm going to do that. That's where you get in trouble financially. And I've never seen anyone regret the planning process.
Yeah, when it comes to money, no decision should be made in a vacuum. It should be made holistically, because whatever decision you make on one end is going to affect something else.